Hello, Anu. Hello, Anu. Anu, are you able to hear me? Okay. We'll start. So no more introduction required. So I'll just go to the syllabus itself. So module 1, we are almost at the last two concepts which are about in the introduction to performance management. The two important concepts which are there are about customer profitability analysis. So in short, it is called as customer profitability analysis, CPA. So CPA, again, as the name suggests, it is about the analysis about the customer's profitability. So it's not just individual customer, it is the segmentation of the customers that is then monitored and is required to be monitored. So at times organizations are geared up to have profitability check as per the market segmentation or the customer segmentation that the organization has done about. And then whether a particular segment needs to be focused more or not, that depends on the profitability analysis basis which the marketing strategies gets decided, or maybe the product alignment is also required to be done depending on the profitability of the respective market segment. So it's like a segment reporting which traditionally is followed for financial statements. Okay, so let's understand what it means. So customer profitability is a key parameter in assessing a company's financial performance, because for every business, customer is the king, customer is the god. So all the company's financial performance are always dependent on the customer's profitability parameter. So profit generation depends on the market share, that is the quantity sold, which is directly linked to the customer base. And in that, comprehensive customer knowledge helps organization in retaining existing profitable customers, acquiring new customers to boost the market share, segregating profitable customers from unprofitable ones. So in a way, which segment to be targeted, which segment to be focused, these insights are gained through this CPA. Customer loss negatively impacts cash inflows and is an early sign of financial distress. So while analyzing the customer profitability, if at all there is a decrease in the profitability of a particular segment, so just to give an example of telecom sector, there are a lot of port-in port-outs that happen, and which is without any additional cost to the customer. So telecom industries customer segments accordingly has to be targeted so as to retain the port-outs. So if at all the attractive points for port-in or port-out are always in terms of telecom industry, to give an example, are always depending on the network frequency or network what you can say frequency that is being seamlessly provided to the customer. So network service provision, how best it is, it depends on that. And secondly, the plans which are floated around by the telecom industry. So the pricing. So the service and the pricing determines the customer's profitability, and customer loss in a way hugely impacts the cash inflows, because suddenly the port outs starts happening because of the poor network, and if at all the prices are not competitive. So currently if you see, though Vodafone Idea merger has happened, there are impacts in terms of the customer base of the Vodafone Idea. So a lot of port outs are happening to Jio because of the attractive pricing strategies and the seamless service, network service that is being provided by Geo also. So nothing specific to a particular company. I'm just trying to give an example in terms of how the impacts of the customer base are impacting the profitability of the at the company level. So by looking at the customer profitability in a way, in which telecom sector or telecom circle the focus of market strategies have to be done, these insights are made available because of the customer profitability, and that too again circle wise. So telecom circles, uh, within telecom circles, what sort of market segmentation or customer base is, because in rural areas the dynamics are different, in urban areas, the urban circles, the dynamics are different. Again in remote areas like northeast, so northeast again the dimensions are different of customer satisfaction, and hence the customer profitability gives lot of insights for the marketing strategies also, and overall financial performance gets impacted because of the customer base. So let's understand how this customer profitability analysis can be done. So as I said, the customer segmentation is the starting point based on the revenue generated and cost attributed to each segment. So how much cost is getting spent for retention of those kind of a particular segment of customers, that in a way is the starting point. Revenue generation is one from a particular customer segment, and cost attributed to that each segment, how much cost is getting spent on that particular segment. So typical profit set, whether that particular customer segment is turning out to be a profit center or not, or it's purely a cost center, because at times just to retain the market share also, a particular segment of customer base is also required to be continued with the service. Especially if you see in e-commerce, you are luckily in that space only. So the preferences and needs, and to adhere to those preferences and needs of that particular customer segment. For instance, youth. Okay, youth is a huge demographic segment which is available for every market player, every industry. And if at all my product is not youth centric, then the profitability overall of that particular product segment is likely to get impacted, because that particular youth as a market segment is not being catered to their needs and preferences. So customer segmentation is the starting point for obviously customer profitability. Post that, activity based costing, which is popularly known as ABC, is used to identify profitable and non-profitable segments. So this is nothing but purely within a particular business segment, the further customer segmentation is being done. So if you bring in front of you the segment reporting, in segment reporting the businesses are being identified as various business segments are identified, and within that particular business segment what sort of customer segmentation is being rather what sort of customer segmentation profitability is being assessed. So for that, activity based costing is used to identify what sort of profitable segments are there, what sort of non-profitable segments are there, and maybe accordingly the focus of the entire strategies in terms of production, marketing has to be aligned only towards profitable segment, or else there is a scope of revenue generation by addressing to the non-profitable segment, turning them into profitable segment. So these are the various insights that can be gained from customer profitability analysis. So objective obviously maximize the profitable segments or maintain the profitable segments so as to maintain the sustainability of the business, and reduce or eliminate non-profitable ones or convert non-profitable ones into profitable segments. So extra efforts will be required, extra market alignment has to be there to target those non-profitable segments, converting them into profitable segment, so that at least sustainability is achieved of the businesses. That's what the insights are being provided. Now typically let's get into the stages for successful CPA implementation. First, understand the customer segmentation, on what parameters the customer segmentation can be done. One could be obviously, as I said, demographic segmentation based on geographic location, age, sex and income level. That could be one parameter for customer segmentation. Second would be psychographic segmentation, which is more of the preferences or the customer behavior, attitudes and interest. That could be the another parameter for segmentation. Revenue attribution to each segment. Annual revenue per segment is calculated considering the discounts and service fees also. So the revenue allocation has to be done, revenue attribution to each segment. So this is possible only when your accounting systems are geared up to map that kind of a customer segmentation in your accounting systems. Okay, otherwise it's very difficult to have average annual revenue per segment also. So again, as I said, the segment reporting in your financial statements and in your accounting systems has to be well mapped so as to give insights for customer profitability analysis. So that's the base of for any CPA, the business segment reporting, how well it is being managed and how well it is being captured in terms of financial data. That will be the insights for every segment then. Profit calculation per segment. Activity based costing is used to allocate both direct and indirect costs. Example, marketing, distribution, quality control, order fulfillment. All these activity costs has to be then accordingly allocated to the respective segments. So the logic of allocation also has to be decided by the management so as to arrive at a proper customer profitability segment. And so in a way you are deriving a segmental reporting or segment profit and P&L statement, right? So the way the business segment is required, segment P&L and segment balance sheet is required to be prepared in financial statements. Similarly, within that particular segment, the customer wise segmentation can be done, customer base segmentation can be done basis on the demographic and psychographic segmentation, and to that extent the P&L of that particular segment can also be derived so as to really get insights whether, again it gives insight whether the demographic segmentation is properly being done or not, whether the parameters of segmentation are right or wrong. Those also insights are made available because of the CPA. After the profits are arrived segment wise, the customer database is ranked based on the profitability. It identifies value destroying customers whose cost exceed revenues. So this is again the profitability analysis part which comes into. So first, so the stages are: first identify the segments on certain parameters, arrive at the profitability of that particular segment, which is revenue attribution to of that each segment, then the cost allocation of that each segment, basis which the profits are arrived, and then after that profit, those profit analysis or profitability analysis is to be done, wherein value destroying customers, wherein the profits, that particular segment is not if at all profitable, then those costs are required and those costs are exceeding, then the cost realignment has to be done so that those value destroying customers are not anymore targeted, and or else some cost reduction measures have to be followed. These are the insights from the profitability analysis of a segment. So strategy development is aligned towards is maximizing profits from profitable customers. So this balancing act has to be done by the management, that profitable segments should be sustained, non-profitable segments, if at all any additional cost is not to be incurred, at least maybe not to be focused henceforth, or convert this, or that non-profitable segment could be the henceforth focused area for every department in terms of marketing, production and cost alignment also. So maximizing profits from profitable customers, handling non-profitable customers by elimination strategy, whereby increase prices, modify product design or make services unsuitable for them so that they die down naturally, and maybe we forego that kind of a profitability. That is also at times a strategy which is a wiser strategy, instead of continuing those efforts catering to those non-profitable segments. And second could be inclusion strategy. As I said, improve the profitability by increasing revenue or reducing cost of those non-profitable segments or non-profitable customers. Example, product re-engineering, packaging modifications that will in a way translate or convert those non-profitable segments into profitable segments. So this is the benefits or stages of implementation of a CPA. And lastly, obviously continuous review of the strategy has to be done, evaluate impact after an appropriate period to refine pricing, cost reduction and customer service strategies. So a lot of insights can be achieved in terms of improvising the performance of a particular segment by the organization by following CPA, that is the customer profitability analysis. So this is one of the dimensions of performance management. Now how typical customer profitability database analysis, because this is at the top level of the segmentation which is being done basis the profitable segments or non-profitable segments. Further deep down of the customer database also is required to be done. So analysis of the customer profitability database is to be assured or ensured. Customer profitability database helps in formulating and reviewing business strategies around that particular profitable segment or non-profitable segment. So every activity of the business is realigned accordingly, because customer is the God, customer only gives the revenue to you, which helps maintaining and sustaining my business. So customer profitability database helps in formulating and reviewing the business strategy itself, whether we need to go back to the drawing board, whether we need to change the product segment also for that matter to cater to that particular customer segmentation, maybe to keep that customer segment alive all while new and newer products and newer marketing strategies have to be adopted, so that the customer always remains hooked to the business or to that particular product. That's the insight that are being made available by this kind of a CPA, which involves again customer database profitability also. In large organizations, for this another tool which is there, which is called as a decision grid analysis. In short it is called as DGA, is used instead of simplistic strategies. So decision grid analysis is another mechanism. It's more or less like a balanced scorecard, wherein this DGA graphs customer profitability against sales volume to identify profitable and non-profitable customers also. So now this DGA in a way analyzes the customer database. Where are we going wrong? What sort of demographic alignments I need to do? What sort of psychographic alignments of the customers I need to do? Maybe at times customer awareness has to be created a lot of penetration push strategy also at times will have to be done. So all these realignment insights are possible because of this decision grid analysis which is followed for the customer database analysis. So now from the profit, the identification of the segments are being done. After the identification of segments are being done, whether the segmentation demography is required to be aligned, because that's the way the segmentation has happened, or whether the psychographic parameters of the segmentation has to be dealt with. So whether the product which the marketing guys are pushing, is it really the need of the customer? Is it really the interest area of the customer? So that's what the strategies alignment has to happen, basis the demographic or customer profitability database analysis gives to it. So more in deep, the DGA, how it classifies, let's into that. So there are 4 segment classification which is done of the database. The loser category is identified. Loser category is that of the customer database wherein there are low sales volume and negative contribution percentage. For this, the strategy that should be adopted is the elimination of these customers. So straight away these customers should be faded out, removed from the system, no more targeting those customers. That could be one kind of analysis inputs which are getting through this DGA mechanics or tool. Another category or segment of customer segmentation would be problematic customers. So high sales volume but negative contribution percentage. That again strategy can be built around to turn around or eliminate if new customer acquisition is promising. So instead of spending more time, cost, efforts on these kind of problematic customers, maybe switch over to new potential promising customers and entirely time, cost, efforts to be targeted towards that kind of a promising, profitable customers, probable and potential customers who can help us in. So in a way it's like realignment of the efforts. Instead of targeting problematic one, maybe one portion of the activities can be kept focusing on the problem solving customers or solving the problems of the customers. At the same time counter it by having more promising potential customers. The efforts alignments can be done. The third category or third segmentation which can be achieved through this decision grid analysis is potential customers. So low sales volume but positive contribution. In that case, strategy would be promotional schemes to be focused for these kind of customer base, and loyalty programs to increase the sales, because right now the sales are low in this segment, and hence to attract them more, to keep them hooked to the product, maybe certain promotional schemes and loyalty programs are required to be drafted or framed afresh or introduced afresh to increase the sales of these kind of potential customers and move them into winner category. So the winner category is the classic one which has to be always catered to. The focus always has to retain the winner category of segments. So high sales volume and positive contribution. The strategy over here is the retention strategy and relationship building. So always there has to be a proper timely engagement, timely responsive time towards this kind of winner. They should be kept happy. So the customer index for these winner categories has to be always maintained, because they are going to ensure sustainable revenues for the business. And rest of the three categories, in a way, the damages which are happening, obviously not in potential, the other two, loser and problematic customer segment, the damages that are happening or the costs that are getting incurred can get recovered through this maintenance of the winner category. So this is another tool which helps us to analyze the customer database. So in a way, customer database, with the help of decision grid analysis, 4 segmentations are focused, or customer database gets segmented into 4 categories. So it's a further segmentation of the CPA. So CPA has been done based on the certain segmentation which is demographic and psychographic. Then further the customer database segmentation is achieved through decision grid analysis, whereby 4 categories or 4 segments emerge. One is the loser, which can be done away with. Second is problem, not much effort should be given because it is low contributing segment. Potential can be countered, hedging can be done by way of a focus on the potential customers by hedging the problematic customers. So it could be a hedging strategy also for that matter. So focus can be given on the potential customers by introducing potential schemes, loyalty programs, etc., whereby those increase sales happens and move them into winner category. Winner category will be sustainable customers. They will be always loyal, high sales volume and positive contribution. So retention is always the focus of winner kind of a segment, winner category customer database. So this is what is DGA, decision grid analysis. Now let's move to the different kind of a concept altogether, which is called as corporate credit rating score. Now this is again a performance management tool whereby we get to know what sort of credit rating, what is the reputation, what is the financial reputation of this particular business can be gauged. Someone has to measure that. So the financial performance of a particular corporate is done by way of a corporate credit rating. So how this credit rating score works, let's have an overview on that, which is part of our syllabus only. So if you look in the syllabus, these 2 chapters are at the end of the module, and these are very small, what you can say, 2-pager, 3-pager concepts which are there. So let's have a overview how this financial performance is rated by someone outsider. Up till now what we looked at, CPA or profitability analysis or financial analysis, was insiders who does the analysis. Now this rating or performance management is being done by some outside agency. What are the parameters that these outside agencies always hold for on the basis of financial performance of a particular entity? So that's what we will see now. Entities often overestimate financial health using creative accounting. So because I am an insider, I am doing my own analysis, I am tend to ensure that I use some means and mechanism that will help me to show my analysis better and better, because it's my self-analysis, right? Profitability analysis or financial statement analysis is more of a self-analysis. Now this typical That's why it's not at times reliable by the outer world, because you yourself are analyzing or measuring your performance, and hence some outsider agency who is authorized, who is knowledgeable, who are trained accordingly and are looking at your financials in a different perspective, pitching with the whole industry or the economic environment, those rating agencies analysis will be more relevant or more reliable also for that matter, because they are outsiders who are doing. So classic example is about Hindenburg, you know, which happened for the Adani. Now though Adani has been repeatedly publishing his own financial statements from time to time, including quarterly statements and projections, etc. But the moment someone else has rated him in a different way or has analyzed the business in a different way, it had impact on the overall business performance also of the Adani group. So this is the classic example of this kind of rating agencies. Now that was not a rating agency per se, it was a research agency who was analyzing the financial performance. So even research agencies also impact or analyze your financial performance. That's how. So rating agency in a way is nothing but a research only. It's a research analysis only which rating agencies does. So let's see how that happens. So credit rating by third parties enhances trust and reliability in the financial projections. So they use some scientific methods, statistical methods, mathematical methods according to the industry also, whereby that particular business is benchmarked against the industry performance also, right? So the financial projections are done more scientifically by the rating agencies. They have their own technical statistical tools and models which they use for rating a particular business. So let's understand what is the difference, because this at times are being interchangeably used. So what is meant by credit rating versus credit score? Now the classic distinction is credit score is of an individual and credit rating is of a non-individual or a business organization. That's the basic distinction between the analysis of the financial performance. So credit score is given to individual performances and credit rating is being given to the business organizations. So that's the basic distinction between credit rating and credit score. Let's go deep dive. So credit rating is based on expert judgment expressed using alphabets. So in a way, like the way, just to give a simile, till a particular point in time in education, there was always a mark system which was being used. So out of 100, how much marks you have got? So numbers was the parameter which was getting used for measurement of your performance. But that has created impact psychographically on certain students, and hence some psychologists sat together and felt the need that the education system should not be mark based but then grade based, and hence the no more it's numeric, it's now grading system which is being used. So alphabets are being used to grade the performance of students. So on same lines, this credit rating uses based on expert judgments expressed using alphabets. So how these alphabets are used, we'll see down below. So credit rating in a way, and score always is numeric. So that's the distinction between the credit scoring or credit rating. So credit rating uses alphabets and credit score is numerical. So that's one distinction which is there. Again, credit score is based on mathematical models expressed as a numerical value, and credit rating is based on experts' judgment. There are no scientific or mathematical models that are used for credit rating, and grading used for basis of alphabets. Then another distinction is credit score analyzes historical data, while credit rating predicts future repayment ability. So predictions are different, or predictive mechanism is used. So in a way, for credit rating, how much is the liquidity of that particular business is gauged to ensure that the performance insolvency is not there, and hence, so obviously, if at all there is a unpredictability in future payment capability of a particular business, then the business is put into question mark, because there is a solvency issue in that case, and hence they are degraded from the rating accordingly. And typically that's why credit rating of a particular instrument is also being done And the non-banking financial companies or banking financial companies, the instruments that gets floated are getting the credit rating. For example, let's say Mahindra Finance is floating a public deposit scheme. That will be obviously a rating will be given to that public deposits, and that public deposits rating will be always alphabetical. It is a rating, it is not a score which is given to them. So in common parlance we say that it's a AAA company, a AAA plus company, you know, it's a rating, whereas not a score. So, and credit score is given when you analyze the past performance. That's the difference between historic data and future performance. Historical performance and future performance. Historical performance is gauged for credit score and gauged, and credit score is given. Future performance is measured and credit rating is given. Another distinction, as I said, credit rating is used for corporate borrowers, while credit score is used for individuals. So whenever individual borrower is there, that's where the CIBIL score. So CIBIL score, if someone sees, it's always in numbers. We can see that CIBIL score on the GPay also, you know, that facility is now there. So everyone, the score of your performance is measured, past performance is measured, and according the score is given to you, that's CIBIL score. So it's a credit score and not rating. So our individual performance is never scored, it is never rated, it is scored, right? So that's the distinction between credit rating and credit score. Now let's see who does this. So credit rating agencies in India. So there are 7 SEBI authorized credit rating agencies in India: CRISIL, ICRA, CARE. So these are all short forms of, so credit rating. CRISIL is something like Credit Rating Institute of something. What is that? Credit Rating Information System. CRISIL. So Credit Rating Information Services of India Limited. So that's the short form of CRISIL. ICRA is India Credit Rating Agency, I guess. Or ICRA? Okay. So that's ICRA. CARE is something again a short form. What is that? Cooperative for Assistance and Relief Everywhere. Okay. CARE. India Ratings is another agency. Acute Ratings is another agency. Brickwork Ratings is another agency, and Infometrics. So these are the 7 predominantly SEBI authorized or SEBI registered credit rating agencies. So again, this is being regulated. It's not that anyone can do whatever the way the rating, because the ratings impact the investors' confidence. Okay, so it can't be just left to anyone. They can do, but it's not authentic in that case. And hence, wherever there is any issue, so even IPOs are nowadays required to be rated. Okay, if you have seen, SEBI has mandated that kind of a regulation for a IPO also. So public deposit schemes so always has to have a rating, because that again is mandated by RBI also. So so as to gain investor confidence, and hence anywhere, if at all any investment decision is required to be made, it has to be checked by way of a rating which has been given by an authorized rating agency only. And that's why CIBIL is being considered when an individual borrower goes to the bank for any loan, as small loan as a two-wheeler loan. So for even two-wheeler loan, the immediate score which is asked by the representative, how much is your CIBIL score? If at all it's good, then only he starts talking to you. If it's bad, then it's like a customer who is not going to be converted into a sale. So there and there itself, they don't, you can make it out immediately in the showroom. The treatment that is given for a good score person or a probable potential customer is different than the low CIBIL score customer. That's the immediate first hand, because why otherwise then, you know, spend time, cost and efforts on that kind of a customer. Because if initially only I know that this particular customer financing can't be done, he's not a potential customer, he's the problematic customer or loser customer in a way, right? Then why not, I will not spend my marketing strategies and call the market representative to help him out with the financing schemes also. So the dealer is also smart. The immediate dealer, if at all, let's say I need to buy a scooter. So that has happened with me also when I went to buy a scooter particularly. After the product has been looked upon, the model has been freeze done. The immediate question is, how are you going to make the payment? Are you going to make the payment outright? If I say outright, then the financing option and the rating is not required anymore, right? If not, no, I'll buy it on EMI, then the financing options has to evaluate how much is the repaying capacity of yours. So immediately then the financial requirements or the data are asked, you give me 6 months financial statement or bank statement of yours, the IT return, and they immediately ask for the CIBIL score. If you don't tell, they have their own mechanism to check your CIBIL score. They already have this tie-up with the authorized agencies, or so these products are sold now. So all these rating agencies in a way is a service provider for rating for the NBFCs and banks. So again, for these rating agencies, it has turned out to be a revenue model, giving rating services to various banks, various financial institutions, various non-banking financial institutions. So or finance partners or channel partners. So these kind of models are prevalent nowadays. So the calls which are also coming to you for marketing has this kind of a credit rating score available with them, basis which then only those calls are made. Otherwise, why spend money on calls, right? So these are the insights which they get for the potential customers or high value customers or winners for that matter. So if I have to push a loan product, I have to call a winner only, na? How that winner can be decided? The first parameter is to look into the score of his. Then only then it makes sense to push a loan that okay, you have been provided with already a pre-approved personal loan. You know, we get those calls or SMSs also for that matter. That is done when the basic scrutiny of rating is done already. Whether he has a right payment history, are there any loan defaults, that get reflected from the CIBIL score. So the rating agencies plays a critical role in financial performance analysis for individuals as well as business organizations. Let's understand how CRISIL, a division of S&P Global. So Standards and Poor is a global rating agency or of a global standard, MNC typically. They have acquired stakes in CRISIL. That's why it's now a division of S&P Global, Standards and Poor's Global Rating Agency. So CRISIL is now of a 100%, I won't say 100%, it's a division of S&P Global. So India's first credit rating agency, founded in 1988, it controls 60% of the corporate debt rating market. So again, every rating agency has a specialization. This CRISIL has a specialization in rating corporate debt segment. So corporate bank, public deposits, company deposits, bank deposits are rated by CRISIL predominantly. That's what the corporate debt market is all about. Corporate debt means corporate debentures, privately placed debentures issued by certain NBFCs, or privately placed preference shares or convertible bonds. All these instruments gets rated. So these are typical instruments in corporate debt market. Now those are required to be rated whenever these kind of issuances are happening by private placement also for that matter, or public issue. Either ways, those are rated by a CRISIL. So you will always find CRISIL rating for those kind of products or corporate debt markets. They uses different rating scales for long-term and short-term instrument. So depending on the type of instrument, the rating also has to be, they can't rate it at par the long-term segment and the short-term debt market also. So long-term ratings are AAA highest, which is, so there is a range. So AAA is the highest and D is the lowest. And short-term ratings are A1, A2, A3, A4 up to D. So if short-term is typically of a shorter duration, less than 1 year, so T-bills again, or short-term loans or short-term public deposits are again rated in a different way than long-term deposits. Okay. Okay, so ratings range from AAA to D. D is lowest and triple is the highest rating. Then again AAA plus is also another rating category which has been used. So there are degrees of highest. Within highest rating also there are certain degrees. Double plus, 2 plus, single plus, you know, all those again dimensions are coming. So just to give a classic example, in Indian Idol, if someone has or Saregama for that matter, you know, the rating which used to be given to the participants was always like Sa, Re, Ga, Ma, Pa, Dha, Ni, Sa. Now after Sa, Varcha Ni. Okay, so that's that's another rating which has been brought into. So that kind of rating logics are built in by these rating agencies, so as to bring more and more classifications into the distinctions into the products also, and categorization of the respective issuers also. So whole lot of logics are being built up into these ratings. Just to have that rating scale, it's a tabular, it's available in the, if it's not visible to you all, it is available in the study material which is being given. So if you see CRISIL AAA, CRISIL AA and CRISIL B, triple B, CRISIL BB, CRISIL B and CRISIL C and CRISIL D. So these are the symbolic rating categories or symbols that are used for the rating categories. Then comes symbol rating categories like CRISIL A1, A2, A3, A4 and CRISIL D. This is used for short term. Let's see the structure finance rating scale, which is again bifurcated into long term instruments and short term instruments. So CRISIL AAA, then CRISIL AA for and ASO CRISIL, ASO CRISIL triple B. So again these are like the various rating scales which are being managed. Then another column is credit enhancement rating. So long term CE instruments rating category, CRISIL AAA, CE, CRISIL AAA, CE, CRISIL AA, CE CRISIL, CE CRISIL triple B, so on and so forth. So this table is the CRISIL rating scale for fixed deposits, which is a popular, you know, instrument which is available for we retail investors. It's F AAA. So first alphabet in a way classifies the kind of debt instrument which is there. So F stands for fixed deposits. So F AAA means it is about fixed deposits. Then F AA, FAA or FB, FC and FD. So these are the various categories of rating scales which are followed by CRISIL. Slowly and steadily there is always an improvement in the credit corporate rating which is happening. It's a continuous process. Credit rating changes based on the financial performance. So if the financial performance improves, then that rating from D, you upscale up yourself. You keep on upscaling yourself, and every institution tries to aim at the highest rating which is there, whereby the investor confidence can be achieved, the market confidence gets established for that particular financial product or financial performance of the organization also. So in a way, everyone tries to get the highest rating. Obviously, even as a student also, we always try to get a highest grade or highest marks. So always every small child is fascinated by the A rating or A++ or a AA rating given by. So even our children also run towards us the moment their report card shows good rating. So that's how the performance is being measured. These CRISIL ratings are under continuous surveillance until the rated instrument is fully redeemed. So it's not just at the time of issuance only that the rating is done, whether during the tenure of that particular instrument till the repayability is achieved, the CRISIL keeps on amending the rating of it. So at times, because the financial performance is never static, maybe at the time of issuance the company may be F AAA, but over a period of time, if the rating has gone down at that particular business entity, then it comes on to that particular instrument, and in a way then the customers in confidence or investor confidence starts losing if there is a downscale in the rating which happens because of the financial performance of the entity. So CRISIL's rating are under continuous surveillance until the rated instrument is fully redeemed. So up to the last repayment, the rating continues happens. So that's where the tenure comes into play. So if it's a long-term tenure, accordingly the rating will have to be monitored. If it's a short-term tenure instrument, the rating will be aligned accordingly till the last redemption happens of that instrument. Rating upgrades and downgrades, upgradation due to improved financial health and risk management. So obviously the company keeps on striving for better, and most of the time your rating in a way, so even as an individual, if at all because of a poor credit score you are not able to get loans, then the individual has to keep on striving that his repayments, credit card payments, loan repayments, EMI never get defaulted. So if that is assured or ensured by the individual, his rating score improves. Okay, we have seen this. If there is no default in your earlier any other loan also for that matter, the credit score improves. If at all there is any default in a particular card payment also, immediately the rating gets impacted, indicating that maybe some kind of issue about liquidity is there, about cash flow is there of that particular individual. Maybe his repayment capacity is likely to get questioned by the lender the moment rating gets followed. So at times for high net worth individuals also, the ratings are monitored by the lending institutions. It's just not at the time of giving loan. It's a continuous process. They keep on, the credit department keeps a tracks on the record, the ratings also. So at a periodic interval, every borrower's ratings are verified as a part of, because if it's an indication whether that loan is going to turn NPA also for that matter. So for banks, this continuous monitoring of rating or CIBIL score of an individual borrower is an indication of NPA or likely NPA. So those borrowers whose ratings are getting downgraded, they are in your NPA reports or in your probable NPA reports, those kind of downgraded borrowers are slowly gets highlighted into the probable NPA reports. So if someone has seen a NPA report of a particular bank or a probable NPA report of a bank, slowly the downgrading rated borrowers slowly get converted or getting captured into the probable NPA report, because then it's a highlight to the recovery team or the branch manager that something is likely to happen about this. The repayment is likely to get hampered, and extra efforts then accordingly the branch manager will have to put so that that probable NPA doesn't turn out to be an NPA. It's an indication. So upgradation due to improved financial health and risk management, degradation due to declining credit worthiness and increased financial wealth. So these are the another way of measuring. So rating in short is another way of measuring performance management. So let's see what is meant by, so we saw credit rating, which is relevant to more of corporate borrowers or corporate entities. Now let's see individually how credit scores are being monitored or measured. Credit score is a mathematical measure of an individual's credit worthiness used by banks and lenders to determine loan eligibility, interest rate and repayment terms. I have already explained this in an elaborate way. FICO scores, which is US based, FICO score is a US based, a 3-digit number is used to assess the credit risk. CIBIL score in India is introduced in 2007, and this CIBIL score ranges from, because it's a numeric value and no more gradation is used. So it's nothing like D and AAA for individual scores. It's the 300 to 900 is the range. Higher score is the better loan approval chances. So more the score, more the lending probability is there. Now how this typical scoring is done, let's understand. Based on 4 key factors. So for any credit analysis or credit evaluation of an individual borrower, which are the 4 parameters typically which are looked at? The repayment capacity is at the priority. So payment history, how that particular borrower has been historically paying their earlier loans. So if the late payments are happening in the earlier borrowings, then it's a lower in the score. So payment history, late payments lowers the score. High credit balance increases risk, lowers the score. So if at all the credit balance is always on a credit card, if your credit card payment history shows that you have been paying the credit balances in a EMI fashion, you have that option. Whenever you have used your credit card and whenever a bill gets generated, there is always a minimum amount which is shown to you. At least pay that much. Okay, if a customer who uses a particular credit card and is not in a capacity to make the full bill payment which is due and always chooses the option to make the minimum amount which is asked by the credit card company, then there is a question mark on the borrower. It reflects something that he is always choosing a minimum amount due only and not paying the entire amount of the bill. And it's not that by paying minimum amount you can like sleep, have a peaceful night. On the balance amount there is interest which is charged by the credit card company. It's not free of cost. It's just a minimal, it's like minimal contribution that is done towards recovery, but the rest of the balances are charged with interest. Okay, so high credit balance increases the risk and lowers the score. A credit mix is also another factor which is looked at. A good mix of secured and unsecured loans improves the score, because yes, it's not a tendency of always having a personal loan. It shows the intent of that particular borrower, or his behavioral pattern also gets reflected, that always he goes for secured loans or whether unsecured loans are also procured. So credit card history reflects the unsecured loans, and secured loans like vehicle loans etc. are always the, or home loans for that matter, reflects the reflects that he always goes for secured loans. So there has to be a good balance between the secured loans and unsecured loans. That again reflects in the rating or in the CIBIL score. So this is the 4th parameter or 4th factor which is considered by CIBIL. And last is debt burden. So debt burden is nothing but frequent loan inquiries, and high debts reduces the score. So at times unknowingly or knowingly we have a habit to just casually ask whether I can get a loan or not. So the moment a holding probable loan inquiry is done, if you have monitored that, immediately the rating gets impacted. By doing a cold inquiry also, casual inquiry also of a loan reduces your CIBIL score. Why? In a way it reflects that he is, what you can say, less on cash. So liquidity is the issue. So immediately the score is lower down. In my case also, at times what happens, you get these cold calls, and once you get these cold calls, at times you get hooked. Okay, let's see what I can get. So the moment we see what I can get, and you tell that calling guy, okay, tell me how much is my loan eligibility on the product which you are suggesting. So the moment you do this kind of an inquiry, your credit score goes down. So debt burden, frequent loan inquiries and high debts reduces the score. So these are the 4 parameters basis which the credit score is done by the CIBIL. So let's understand the FICO US mechanism, how the score ranges. So less than 580 is poor, and 800 plus is exceptional. Okay, so right now the table, again this table is picked up from the study material only. So I am not too sure whether it's an updated rating scale which is being currently also prevalent. Whatever is there in the study material, I have tried to follow that. So this is the score range which is there. So so what is the CIBIL score that we follow? We'll see that. But FICO traditionally for US market follows the rating of 580 to 800 plus, right? So that's the range. So 580 means poor, and the description over here is like score of less than 580 implies that your score is well below the average score of US consumers and demonstrates to lenders that you are a risky borrower. So every score has been given a description, analysis to it, what it means. So even in school also, A plus means outstanding, beyond, above distinction. So if you have seen a mark sheet typically, at times certain subjects are rated, certain are graded, certain subjects are given marks. It's a combination of both. So wherever there is a grading, what that grade means also, there is a small table which is given, A means what, B means what, C means what, and D means what. So again, that description is similarly provided in this kind of scoring mechanism. Let's see what is meant by 800 plus. Your score is well above the average score. So well above the average customer base in US, and clearly demonstrates to lenders that you are an exceptional borrower. Your credit rating, your payment history is exceptionally well and above average of the US consumers. So you are a good potential winner. That's the insight that the company gets, that he should be ensured that he should be targeted and converted into a customer of us. If at all a particular instrument is being floated around, and if that credit score is 800 plus, then he is assured probable potential winner customer for us. Why? Because his history is very well established above average US consumers. So why should I bother targeting the average customer? He is the probable winner for me. My more effort should go into targeting this kind of a customer, isn't it? Because my product is getting secured, my repayment is getting secured by selling the product to that particular customer. And there are very less chances that this kind of a customer borrowing may turn out to be a bad loan. So these are the insights which are thrown by these kind of ratings or scores that are provided by these rating agencies. In between there is another range of 740 to 799, which means very good. Your score is above the average, still above average, and demonstrate to the lender that you are a very dependable customer, dependable borrower. So we can take a chance of giving loan to you. Okay, so that's the risk analysis that a particular credit department does. That yes, he is not good, but he is not exceptional, but very good. I can depend on him. There is some reliability element which gets reflected through this rating. So that's how the performance measurement rating as such is a very good tool for financial industry, especially when the loan products or investment products are required to be pushed, and accordingly the market segments is to be tapped. So I can then accordingly segmentize my market, my customer base also through these rating agencies inputs. So if at all I have to go for a LIC product or life insurance, if I am an agent, LIC agent, then maybe I can push my LIC product to this kind of customer also. I can get some obviously LIC is, why LIC may use this kind of a rating? Because the premium payment, it's not a loan. LIC is not a loan product, but at least the premium in a way is the obligation. So what rating shows that whether that obligation will be met or not. Whether it's a loan product or insurance product, that is not the criteria. Over here the indication that is thrown upon by the rating is whether the honoring of that obligation will be done by that customer or not. So premium is nothing but kind of a EMI only, right? Of a loan, just to draw a simile. Premium is a commitment towards insurance selling. So then I can be assured about that because my insurance business is dependent on that customer's premium. The honor of the claims will be dependent on the premium that is being assured from that kind of a customer. So such kind of customers are the fund source for claim settlement. You are getting the point? So if I am giving to such kind of if I am selling an insurance product to such kind of a customer whose premium history is good, whose rating is good, then I am assured peaceful about the premium payments, which in a way gives me assurance that my claim settlement will be well funded by the premium history. So it's again a cash flow management which is getting managed or assured by this kind of rating inputs. So a lot of insights from these ratings. So let's understand how CIBIL score happens in India. Introduced in 2007 by TransUnion CIBIL Limited as India's first credit scoring model following RBI's recommendation. CIBIL score is a 3-digit number which is like 300 to 900. That's the range. So what is the FICO range? It's 580 to 800 plus. For CIBIL it's 300 to 900, representing an individual's credit history. So again it is a representation of a credit history of a particular individual customer. High score means better loan approval chances and favorable loan terms. So for such kind of a high score, I can customize product to a large extent. So when the loan approving authority gets this kind of a customer file, so as to not to lose on this customer, lot of customized products are sold to the such kind of a high scoring customers. Okay, if you are not willing to pay 8%, 9%, then let's lower your interest rate by some basis point. So that kind of a customization can be done by the credit manager so that this high paying good customer is not lost. So favorable treatment is given to such kind of a high scoring borrowers. Okay, maybe your policy mandates that such kind of a loan product should be given only at 9%, let's say. But because this is a high score customer, to some extent then there is a tolerable limit which is fixed by the credit department. At least then 9% to some extent of 8.5% I can give a rate to this kind of a customer range. So these are the credit policies which are decided according to the scores also. So if you happen to see a credit policy of a bank, there is always a scope of customization for a particular set of customers. So this is nothing but a customer segmentation only. Customer focused segmentation. So it's a strategy. So let's understand, higher the score, better loan approval schemes can be given, better loan approval chances. So I can target those customers only so that the credit department loan approvals happens or the chances are better. And to some extent the branch manager also will get a flexibility to give favorable terms to that kind of a borrower. Maybe in that case the tenure will be increased. Okay, because you are a good customer, I am rest assured about the repayment of that loan, and hence I can customize your requirement and give a longer tenure loan also. Though for that particular product, maybe the loan was only a particular period, but being a high good customer, rated score customer, I can give a leverage or I can take a exception for that customer by giving a longer tenure loan also. Because he is a good paymaster or repayment is assured. He is a good customer, dependable customer. That's how the insights are being given to the rating by the rating agencies to the lending institutions. Now let's see what are the key factors affecting CIBIL score. So as we know that the CIBIL score is about individuals. So first and foremost, payment history. Late payment reduces the score. We have already seen this. High credit card balance, high outstanding amounts negatively impacts the score. Then credit mix, another factor. So this is no different from what we saw over here as a credit score. So same logic, and same factors are being followed by the CIBIL also. Credit mix, a balanced mix of secured home auto loans and unsecured personal credit card loan improves the score. Debt burden, frequent loan inquiries and increased debt lowers the score. So that's the end of the module, I would say, today, because this was the last concept in this chapter or in this module. Just to recap, we have done with the performance, productivity and efficiency. We saw financial performance analysis. In that, typical traditional financial statement analysis were covered. Procurement to pay as a process, we saw how procurement to pay, again efficiency in the procurement to pay process, and vendor relationship management is an indicator towards performance management. Supply chain, faster delivery, efficient delivery, effective delivery mechanism also reflects your performance. Reverse mapping of business strategies from marketplace using data analytics. So instead of first setting the objectives, then the ways and then the means, it's other way around. First the means, that is customer, what sort of customer preferences and needs are there. Accordingly the objectives are aligned by the entity. Order to cash and customer relationship is all about debtors management. Debtors satisfaction reflects the performance also of a particular business, and hence lot of customer centric approach is required to be taken while ensuring order to cash liquidity is assured. So debtor realization has to be efficiently, seamlessly done. So technological help also we saw, which is being now assured to the businesses so that the customer ensures the payment is happening of the sale proceeds are received by the entity on a real-time basis. So that's all about order to cash and customer relationship management. And today what we saw is about customer profitability analysis, which gives insights about the customer spread also. So the depth and length of the customer base is measured by this customer profitability analysis. So according to that, the strategies can be decided whether there has to be more penetration to be done in this kind of a segment, or the length of that particular segment has to be enhanced, right? So that is reflected through customer profitability analysis. And last, in the introductory module of performance management, we saw how the corporate rating scores are done, how the individual credit rating scores are done, and how the improvisation can be done, how strategies can be built around by the individual and corporate also to improvise the score from the lowest rating to the highest rating, for which what sort of steps are required to be done in improving the financial performance. These are the valuable insights by which the performance management can be assured. So this is about the first module, which is about introduction to performance management. So and so forth. What are the topics? Let's see. So in the next session, we'll be talking about now performance measurement, evaluation and improvement tools, which is the second module. Third module is about economic efficiency of the firm and performance analysis, and fourth is about ERM, enterprise risk management. So accordingly, the weightage of the percentage and marks is also given. So in a way, we have covered 10%, which is 10 marks portion. If at all we are exam oriented approach we have. So 10% or 10 marks portion is done today. Now it's about revision. So I would suggest, as a part of your syllabus, I have already stick to the study material. So in a way, study material is well covered in the sessions that I am taking. Now you have to just focus on after every chapter there are certain MCQs which are there, certain questions which are there, which maybe you can focus as a homework or a self-study for your study purposes, right? So with this, we'll stop for today. See you in the next session, which will be on the next Tuesday, same time 6:30 to 8:30. That's the end of the session for today. It's almost 8:30, I guess, or 15 minutes early we are stopping. That's fine. The topic is itself, not much. Any questions that you have, Rajaram, which we want to discuss? Anu, are you still there? Yes.
Yes, sir.
Do you have any questions? I think you need to unmute yourself. Do you have any questions, Anu?
No, sir.
Sorry, I am not able to hear. Or else you can ask me directly separately. You have already my number. You have attended my last online sessions also. Or you can take the number from Deepa ma'am and you can ask me the questions. I guess I am not able to hear you.
Yes, sir. I think there is an issue at your end.
So we'll stop for the day. Thank you. Thank you, Rajan. हाँ